This approach is essentially used by most valuation experts, appraisers, and even certain founders and VC investors to assess the common stock price rather than the overall equity value. This can be for a number of purposes. Startups usually sustain their operations by issuing options instead of cash or salaries to their employees, and there are certain regulations in developed countries, United States being one of them, that you have to issue options at fair market value or above. Uh, Essentially, this approach can be broken down into four steps: capital structure analysis, waterfall analysis, the Black-Scholes option pricing model, and lastly, the equity valuation. Capital structure analysis is a review of what are the securities outstanding on your cap table right now and what are the rights associated with each security. Now, you might think um, every share would be or would essentially would have the same voting rights, which might be the same. Preferred and common might get the same voting rights, but almost in every instance that I've seen till date, they definitely have different economic rights, at least for startup companies. So preferreds have three major rights that I can think of. One is liquidation preference, the other is a participation, and the third one is conversion. Uh, I've written an article about this. I'll put the link in the description below for you guys to explore additional details about these three rights. But I'll just speak about a sentence about each one of those, just to establish the background for going over this approach. So liquidation preference essentially means that the preferred guys get their investment before anybody else sees a dime. Hence the preference. And this right is enforced, and mostly enforced in situations where the company has to go through a dissolution or a liquidation, which is a unsuccessful exit. Hence the name liquidation preference. Participation is the scenario where, say for example, there is a sale amount which ends up being somewhere between, which is higher than the liquidation preference of the preferred shareholders, but lower than the implied pre-money valuation of the company. So in that particular time period, it would not make sense for for the preferred shareholders to convert. So they also would not want to let go their liquidation preference. So certain shareholders request that I get a participation above and beyond the LP. So once their LP is satisfied, every incremental proceed is distributed amongst the preferred shareholders and the common shareholders, uh, in a pro rata basis. And the last one is conversion ratio. So, say for example, the company goes through a blockbuster exit, one of the WhatsApps, or even an IPO of the Facebooks of the world, and the common stock is 3, 4, 5, 6 times the OIP of a preferred share. At that point of time, it will certainly make sense for the company, for the preferred shareholders, to convert to common given the astronomical returns, although that would imply that they would let go the liquidation preference and the other participation rights. So those are the three rights in a very brief manner. With the Backsolve approach, what you're trying to do essentially is you're using the latest preferred funding round, say Series A in this instance, and then you're trying to reverse engineer the implied value of the common stock, assuming that the value allocated in a fancy waterfall comes out, the OIP, the value allocated to the preferred comes out to be the exact same value as its OIP. So if the OIP matches the allocated value, it would infer that the resulting common stock value was the common stock value in the minds of the VC investors when they did this, when they did the financial due diligence and concluded the valuation for OIP for the company. So we have two preferred shares. You have a Series C and a Series A. You have common stock. You have a few options, and you have a common and preferred account for roughly 95%, 96%, and the options and other dilutive instruments account for roughly 4% of the overall company. So the first step in this would be to determine the strike points. Strike points or break points, as we call it, is what are the different series of events that these shareholders and these share classes will go through. The first one obviously would be the liquidation preference. As I mentioned, this is the situation, or this is the clause that authorizes the preferred shareholders to get their money before any other share class sees their any returns or any proceeds. So the first strike point over here would be $24 million, which is nothing but your share price multiplied by OIP per share. So after the $24 million amount has been uh, provided for the preferred shares, common stock and other dilutive instruments start participating. I've put in a small table over here just for you guys to understand which share makes what at what point of time. So up until the first point, common stock will not see a dime because every proceed up until $24 million will go to the preferred share as $2 for the Series C and $5 for the Series A. The next strike point which we would have would be the participation or the first option issue for the in the money situation for the first option group. So you have options issued outstanding at 0.75. So at that point of time, when the common stock crosses 0.75, these options would be in the money. And if you are an option holder holding an option of to convert or to buy a common stock at 75 cents, you should definitely exercise that. So here we have the second strike point. You have 75 cents multi multiply 75 cents as the strike point, and you have up until that point only common would be participating, because keep in mind that common right now is only getting 0.75 over here, but by remaining preferred Series C and Series A get good $2 and $5 respectively. The next strike point would be the next option group. So you have 1.25 minus 75. In these strike events, you're trying to analyze the incremental proceeds that go to each group. So in this situation, up until 1.25, obviously after this point, these 450,000 options would start participating. But up to this point, you'll only have the common and the previous option groups participating or sharing the proceeds. As you can see, you have a 10.25 million number of shares participating up to this strike point, which is nothing but the common was and the previous group. After this strike point, there aren't any more option groups left. So you come to the first conversion point for your option for your series preferred shareholders. So as you can see over here, we are just incremental proceeds would be $2 minus 1.25, and the participating shares obviously up till that point would be nothing but your common stock, your options at 75 cents and options at $1.25. After this strike point, which is the shares number of participating shares multiplied by the difference of $2 $2 minus 1.25, you will also have a series seed participating after this strike point. And just to put numbers in perspective, at this strike point, at 44.65 equity value of the company, common stock would get $2, series seed would get $2, and payoffs to the series A preferreds would be $5. So say just to explain this a little further, say the company's value goes to 45 million. Common stock would see, I guess, $2.05 or $2.10. That point of time, if the Series Seed preferred shareholders remain preferred shareholders, they'll make less proceeds than the common stock. As such, it would make sense for them to convert, and that's what you see over here in 12.7. So you have in the next strike point is where Series A shares get to convert, and that would be when common stock reaches a value of $5. In that strike point, everybody except the Series A up to that point would be participating. So you'll have 10, you'll have 2 million of Series A, you'll have option group 1, option group 2, which would be 12.7 million, and that's what you will have here. And then the last strike point, once the common crosses the threshold of $5, there would not be anybody who's remaining preferred or an option group. Everybody would participate as common. So that's with the establishing the waterfall steps as to what happens when each of these units cross a certain milestone. The next step in this would be to assess the value of the call option. So this is pretty much looking into a jar for a crystal ball to forecast something that might happen 3 years, 4 years into the future. The startup is not going to exit successfully in the next few months. It will rather take 3-4 years to do the same. So you want to use Black-Scholes option pricing model to assess the value of the call option held at each of these events. So what we have done over here is your value of your underlying asset over here is what we decide to allocate, which can be derived through any other approaches, or just for the time being we have just put in 50 million. Your underlying strike price are the events that we just determined. You have the liquidation preference, you have the first option participation, you have second option participation, you have conversion of seed, and you have conversion of Series A. The other inputs are standard with the Black-Scholes module. You have an input for the volatility or standard deviation. You have an input for dividend yield. In this case, we have assumed 0. You have the input for time to expiration, which is the time period we are assuming for a successful exit, and obviously the risk-free rate. You calculate using a standard Black-Scholes model. If you guys need any support on this, I can create a separate video. But at the end of the day, you get the incremental value assigned with every call option on the company. The asset being 15, the value of the underlying asset being the value that we are the company's current value, and the strike price being the waterfall strike price that we determined. Using this, you can assess the incremental call option values to each of these strike points. First, you calculate the call option value of each of these strike points, and then you subtract the previous one from it. The next one is what proceeds are going to each shareholders at what point of time. So over here we have just input number of shares: 2 million preferred, 4 million Series A, 10 million common options, and option group 1 and option group 2. In the first strike point, obviously you will see only Series Seed and Series A are participating, hence you just have these two numbers. Same thing in the second strike point, only the common stock would be participating, because it wouldn't make economic sense for the preferred to participate, and none of the option groups are yet in the money. In the next strike point, at least one option group is in the money. In the second strike point, both the option groups are in the money, and then you have the conversion benefits for the preferred shareholders. Over here we are just assessing what is the percentage of each group participating, and then the next one is where you allocate the value for each of these call option values, incremental call option values that we have determined. So for example, Series Seed preferred stock, you have 17%, you have Series A preferred stock of 83%. Just to make sure that I get the good screen over here. this table over here, where you can see 3.493 series seed preferred stock. So 3.493 is 17% of the call option value of the first strike point, which is nothing but your liquidation preference. So the call option value right now had incremental call option value for this strike point had 20.9 million attributed to it. Series A accounts for 17% of that, as we saw in the value allocation table, and obviously the remainder goes to, sorry, the series seed accounts for 17% of the value, as we saw in this table, and series A accounts for the remainder 83.33% multiplied by the same. So if you add these two, it will come up to 20.958. You do the same exercise for the remaining strike point. So in strike point 2, which is the options starting to participate at 0.75 cents. Obviously, as I mentioned earlier, it does not make sense for the preferred to convert or to let go their LPs, and the 75-cent option is not in the money yet. So you can expect 100% of the payoffs between the LP and the strike point of the option group 0.75 going entirely to the common shareholders. In strike point 3, you have common and obviously the 0.75 options that are in the money now. In strike point 4, you have common and both the options groups in the money now. In strike point 5, you have where the common gets $5. You have obviously the common, you have both the option groups, and you also have the series A shareholders to get the incremental proceeds from $2 to $5 by becoming the common. And in the last strike point, everybody gets money because the LPs for all preferred shares have been crossed, all the options are in the money, so on and so forth. And lastly, just to summarize this over here, you add all of these together in a nice table. You see 6 million value allocated to the series C preferred stock. You do the same addition for all the series A as well. You do the same addition for common stock as well, and this is what you get. This is the final value allocated, assuming that we arrived at an equity value of 50 million. Now you might see that series A preferred stock is getting $4.85 over here. In the Backsolve approach, what you would do is you would update this $15 million value, which is flowing through your Black-Scholes option model, as I'll show you over here. This 50 million is coming from F12, which is nothing but your input for your overall equity value. And I'll just link the common stock price so that we can do some simulations real time. So I'll link the series A price. So here you can see when the value is $15 million, the OIP, the value allocated to the series A preferred, which is assumed to be the latest preferred round, is only 4.85. So you keep on increasing this 50 million to the point that the preferred shareholders get exactly the same number allocated as their OIP over here. So if we do say 54 million or maybe 53.5, you get $5. This is another way of saying that when the VC investors did their due diligence and valuation of sorts, they had 53.5 million in mind given the current rights and preferences of this capital structure. And at that point of time, if I have to assess, we can successfully or comfortably conclude that the common stock during or after this funding event was $2.58. Now keep in mind that this 53 million is drastically different than the implied pre-money value of the company. So if you divide 4 million by 25%, you get, sorry, my bad. If you divide the investment amount, which is 4 into 5 divided by 25%, the pre-money valuation comes down to 18 million, or post-money valuation comes down to 18 million. And over here we are allocating $53.5 million. This is because 18 million assumes that all shares are equal, which assumes that preferred and common have no preferential rights, which is not the case, as we just saw, as preferred have these three unique sets of rights, economic rights attached to it. Hence the difference, and this is what you would want to see once you have done a successful Backsolve. The preferred gets what the latest OIP was, and then you can successfully say that the implied common stock price would be $2.58 at that point. Hope you guys liked the video. Please do like and subscribe and spread the knowledge amongst your friends, peers, and anybody who might need this. Should you have any questions or comments, please drop a comment in the boxes below. Happy to share these materials. Just shoot me your email address in one of the comments and I'll send it over to you. Thank you.